All right, guys, if you've ever been interested in a specific stock and you wanted to actually do more learning and than just simply knowing what the company is and deciding to buy it, you want to actually dig into things and make sure that you know what it is that that company does, then this is how you read companies' financial statements. My name's Hunter. This is Teaching Wealth, and I'm joined this morning by my student, Nigel. Thanks for joining me, Nigel.
No problem at all. Thanks for organizing this.
No problem. So this is called Financial Statements Class 101. Today we're going to do a quick valuation of three different stocks. Nigel picked one of them out. The other two we just kind of went through at random. It doesn't matter if you're not interested in these three stocks. What we go over today, you can apply to whatever stock it is that you are personally interested in. We're going to go pretty in depth on the first stock. I like to go by the teaching method of learn one, do one, teach one. Meaning I'll teach Nigel the first one, then I will walk Nigel through the second one, but he'll be doing the actual work. And then on the third one, he's going to attempt to tell me exactly what he's doing step by step without me interacting at all. And what that kind of does is help show whether it's solidified in Nigel. Nigel and I were just talking before, and he was saying that it's a little hard to get motivated to get all the way through these. And I agree. I remember when I first started, there will be there's different parts of evaluating stocks. There's this stuff, which you would call fundamental analysis. There is charting. There is like learning how to trade on momentum. There is just doing due diligence about the company, where you really dive into the details. You might watch a million YouTube videos with interviews with the CEOs and a bunch of Googling and listen to some of their conference calls and stuff. And there will be aspects of some of those that you'll really find that you naturally like, and others that you just don't like. That's a common thing. Like I love this, but I don't really care for charting and stuff. I just kind of find it a little boring. They're all important, and they're all important to know and use, but you may not like all of them. And I will say that this is by far the hardest to really get started and get your feet wet. But then once you've done this 5 or 6, 10 times, then it will just click in your brain and it'll go much, much smoother.
Yeah, the reason I'm getting into it is because I see the importance of it. And while I have awareness of some other methods, I think this is probably one of the most important things I need to learn is whether these companies make sense to me and where they actually currently stand. So that's why I'm learning it. I'm trying to learn it.
So if you guys want more in-depth information on what exactly all of these different metrics that you see mean, if you can either subscribe to our YouTube channel, because I will be going through and making video by video explanations on the most important ones, or you can join our Discord, and I'll have information on how to do that in the description below. But it's free to just join just the basic chat messaging and to be able to see kind of the little more in-depth explanations on these. As we go through, we're just going to I have like 5 or 6 key things that I look at. This is just to be doing a quick valuation, meaning you've heard of the company, you're interested in it, you want to do a quick dive through just to make sure that they're not either a dying company that you really don't have much interest in getting into, or find some questions that you need to go back through and answer later. Meaning we're going to do Tesla for the first one. You may like Tesla and the idea of Tesla and their products, and you believe in the company, right? But you may find a couple things as you're going through here that you're like, boy, spoiler alert, they don't make much money. And we'll get into that here in a minute. But so what that will do is kind of trigger in your head, okay, I like the company and I liked these 4 things, but these 2 things, I need to listen to some conference calls and do some Googling and figure out why is it that their net income is so low. Is it because they're growing, blah, blah, blah. Anyway, come up with questions for yourself to answer. It doesn't mean that you're not going to invest in them, but it does mean you need to answer questions for yourself that will then help you gauge how confident are you. On my process, how confident I am in the company that I'm investing in kind of helps me decide how big of a portion of my portfolio am I willing to put into them, right? I have a scale 1 to 10 and I kind of will grade it. And then if it's a 7 out of 10, say I'll put 700, but if it was a 10 out of 10, I would invest 1,000. You can do it however you want. I'm just to give you an example of kind of what we might find that how that may affect our decisions. So let's start with Tesla here. Now we're going to be using Seeking Alpha. You can use whatever it is that you like to use. I also suggest to people when they're very first starting out, there's a very useful website called investopedia.com. As you're going through financial statements, you may forget what certain things of this mean. Very nice to just be able to quickly Google in there and find out, remind yourself, re-trigger in your brain what it means. We're going to start with revenues. So to get to let's back out here in case you're a complete noob. You would type in the ticker symbol of the stock you want. When you first get in, it's probably going to be on the summary page here. So whatever website you're on, find the tab that says financials or financial statement or something like that. You'll notice it's divided into 3 separate tabs: income statement, balance sheet, cash flow. We'll start with income statement. And I told Nigel from the beginning when we first started doing this, there are a million seemingly numbers in here, right? Don't be intimidated by that because you're actually not going to use but maybe 30% of them, 40% of them. A lot of them are just minutia that aren't very important. And some of the other ones of them are just like combinations of others. It's just tallying things up. So you really don't have to look at it. So again, by doing the course in the Discord or watching more of my videos as I get them out, you'll learn which ones that are actually important to look at and which ones you can just skip right past. For a quick valuation, I always start with revenues. I'd say revenues is maybe my second most important thing I look at on a stock. And since we're doing a quick valuation, all we're worried about is, has it been going up, right? I told Nigel you can either pick 5 years or 10 years. It's totally up to you. I usually just do 5 because it's quick, and most websites don't give you the full 10. I look at the 5-year here. They brought in 7. This would be this is listed in millions. So 7,000 would be 7 billion. So they brought in 7 billion in revenues, and then at the end of December they were bringing in 31. Now that's a huge jump. So that's definitely a check mark there. So revenues is basically every dollar that they brought in. So for Tesla, it would be selling cars, or I don't know a whole lot about how their battery system works as far as how they make money off of it yet. But any money that they make from their products and services. So what you're seeing here in all these other rows is basically showing how that money how they had to spend money to bring in this revenue in the first place, right? Eventually, we get all the way down here to net income. And you may see a couple different versions of net income. You just want to look at the basic net income here. Anything in accounting that you see in parentheses, it means that it's a negative number, okay? So what this is showing is that they did not make money. They lost money for the first 4 years, from 2016 to 2019. They probably were public even before that. It's just locked. I can't see it. So they did not actually make money until this past year. Now, I've done a little bit more due diligence on Tesla, and I also already know that if it weren't for tax breaks, which may or may not be going away, and incentives that they get being in the business that they're in, they actually still wouldn't have made money last year. They barely would have lost money. What's important, you'll notice if this is a young company that you're looking at, it probably isn't going to be profitable just yet. What is important is that you see a path to profitability, right? So they are now making money. And as I said, even with without those incentives, when I did my researching, they still would have been basically like zero or very slightly negative. So it has improved from negative 674 to basically zero, or it's showing a 721. So that would be a check mark as well. And some things that would come out of net income between revenues and then net income is cost of goods and services, which is just the supplies to build Tesla's cars, right? The metal and the
Raw
stuff
materials.
the whatever it is they put in that cobalt and all the different things they put in the batteries and all that, paying their workers.
Sure.
We'll get into all the details on all that a little later. in different videos, or as I said in the Discord, you can already find all that. So the next most important thing is basic weighted average shares outstanding. So what this is I actually made us a little PowerPoint for this to better explain it. But a company is split up. Every stock you buy, every share of stock you buy is a tiny little piece of the company, right? And what you're doing is you are getting access to profits of the company. And if the company ever went out of business and had to liquidate, they went bankrupt and they had to sell off the company, how many shares you have, what percentage of the company you have, basically you are entitled to the profits from selling off all the stuff that's left. Now, obviously, you're not going to get all your money back. You're going to lose quite a bit of money, but that's the gist of what a share of stock is. So when you see 721 shares here, this is actually, remember, it's in millions. So each one of your shares was only 1 out of 721 million. Now, year to year, if this number is going up, that means they are selling, they are creating and then selling more shares. If it's going down, then they are buying back shares themselves off of the market. So what they would do is they'd go on just like you would, they'd buy shares of the stock and then they would cancel them out so that they no longer exist. Why is this important? Well, as I said, it's basically controlling how valuable your share of the stock is. So let's say everybody knows and understands pizza, right? So number of shares outstanding. Pretend this is a pizza and your slice of the pizza is the yellow triangle here. If it's cut evenly into 8 pieces, then you get 12.5% of the pizza. It's the same with the stock, okay? So 1 out of 8 shares of Tesla is worth 12.5%. If the company is selling shares year to year, which Tesla is right now, and they create 4 more shares of stock, then there's now 12 shares. So your yellow slice got a whole heck of a lot smaller. Your share is now only worth 8.3%. If they had instead, we go back here and they had instead bought back 2 of these shares, then your piece is a whole lot bigger and you're now up to 16.7%. We'll get into in later videos why they would be selling shares, the pros and cons and the details and all that. I'll make a separate video on that and we'll break all that down. But just know when you're looking at this, we're just watching a trend. Is it going up or down? So this is going up. We either want it to stay the same or go down. So that's our first negative on the company. Then we'll skip over to balance sheet and we're going to look at 2 columns here, total current assets and then total current liabilities. You don't have to trend this one. All you want to do is look at the last full year. It really doesn't matter whether you look at TTM over TTM or last year over last year. Just make sure that you don't look at the TCA for this one and then the TCL on this one. Do the same year. I usually go for the full year though, personally. So you would take this number and divide it over top of this number. What this is showing is TCA is current assets. I explain it as things that are easily liquidated. If you're thinking of your own personal finances, if you have a house and a car and you have a savings account and a checking account, the only thing out of those 4 examples that would be considered a total current asset, if we were thinking about it like a stock, would be the 2 accounts, right? Your house and your car, you can't just give me cash for within a day, let's say. Yeah, I mean, you could, but you lose a crap ton of value. You had to go out and sell your car right now. You're going to have to sell it at like a 30+% discount to get me some cash back. So it wouldn't go in the column of total current assets. So this is things in the company that are easily liquidatable that they have on hand. It's usually cash, shares of stock, and things like that. And again, we'll get into all this in later videos. We go to total current liabilities. This is basically debts that they owe within 1 year. So what this shows is, even though Tesla is kind of not making a lot of money, they are in a good position from a debt standpoint. They have almost twice as much total current assets over total current liabilities. So their ratio, so when you're doing TCA over TCL, we said they were, let's say 26.7 over 14.3. So
suppose the important thing there is knowing what an asset is and knowing what a liability is.
yeah, and again, since we're doing a quick valuation, we don't care too much to dig into the details of
Okay.
what each one is. We're just gonna care about what's the ratio. This whole thing, guys, if you're watching and you see, Nigel's done a few of these, so he's a pro by now. But the whole point of what we're doing today is just showing you the key things to look at to do you even care to even look into this company at all. You may find that they are Nikola and they are basically a shell company. The numbers don't make sense. Nothing makes sense. So anyway, their ratio is above 1.0, right? We want them to have at least enough assets to cover the liabilities. And they do. They almost have, as we said, they almost have twice as much, 1.8. So as long as this is 1.0 or over, we're good to go. You could also find it right here, total common shares outstanding. You could find it on the balance sheet as well as the income statement. We forgot to calculate net profit margin. So back on the income statement, after we did net income, we can now calculate what is one of the most, I'd say top 3 most important metrics here. What we can do is calculate net profit margin. So we're going to take whichever year you want, doesn't matter, just use the same one. So 721 and 31,536. So we take net income first and we divide that by 31,536. So excuse me, if you want to turn this number into a percentage, you're going to multiply it by 100. So only 2%. Let me double check my math by running this through my tool here, which I need to get Nigel access to. Yes, so 2%, 2.19% last year. It's quite small. You will find that certain industries have worse profit margins than others, right? So Tesla is a car company at heart. They do their battery services as well. But most car companies have quite low margins. Another example of an industry that has low margins for sure is retail. So if you think about what they do, let's say Walmart, for example, they're just buying items and then reselling them at slightly lower prices. Well, the difference between how much they pay and how much they sell them for is their profit, right? But for one, they can't really buy them and sell them at that wide of a variety, a price, difference to get you to buy them. And for two, they're also having to pay for all these physical locations for you to walk in and buy your clothes and stuff. So we want the net profit margin to be 10% or higher, ideally. So this is at only 2%. This is not great for us. And what that net profit margin is showing, if you're still confused, is out of all the money they brought in, what percentage did they actually have left by the time they paid for everything that it took to bring that money in and paid for their taxes and some other things? What percentage of that revenue number is left? And so 700 is only 2% of that.
It's quite surprising.
And then we'll go to cash flow. Now, I've told Nigel before when we talked in the more in-depth lessons on this, but as I said, since it's a car company and it's low, what you can do if you do this whole quick valuation we're going to do today, and you say, okay, I like the company, but that TCA over TCL, or sorry, that net profit margin doesn't really sit well with me at 2%. So you can say, okay, who are Tesla's biggest competitors, right? So you can say, let's take Ford. And you can do this by hand, or you can use my tool if you have access to it, or however you want to do it. You could just look up Ford and go right to net income and revenues and calculate it for yourself. You don't have to look at everything about Ford. You just care about getting your net profit margin. We'll say, okay, what is Ford's net profit margin then? Is Tesla's close to Ford's? It actually is. It's 1.85% was the average of their last 5 years. Now, they were negative last year, but maybe COVID had something to do with that. I don't know. And then maybe GM. So GM's
3.8.
Yeah, it's a little better. Their last year was actually 5%. That's pretty good for a car company. So we'd say, okay, Tesla is a little behind the other two, but maybe it's not as bad as I quite thought it was going to be. So that can help you gauge, again, your confidence. If you decide to go then invest later, you probably wouldn't put them a 10 out of 10 because you'd be like, well, they got some room to work on there in the net profit margin area. And you can do that for any negatives that you come across, or positives for that matter. You can say, dang, that their net income is increasing like crazy. How does that compare to some other companies? So for it, you can do that for anything if you want. All we have left is cash flow. Now, there are different ways of looking at cash flow. Everybody kind of has their own ones they prefer. I myself, most of my things that I learned is from reading Warren Buffett books years ago, and he's quite an intelligent guy, if you don't know, and he's especially very good at this. This is his jam. This is why he's the richest man in the world, is he really knows how to dig through all of this and all the 10Ks and all that stuff. So I use his method, which is free cash flow, and then you take out money that they spent on actively improving the company, right, which is capital expenditures. You don't count some other little things that can get factored in there, and I can cover that in a later video.
So are we looking at the levered free cash flow or the...
Depending on what website people are on when they're watching this, it is going to show you, as I said, there's different ways of doing this, and not all of these may be on your website, or your website may have the exact one I'm talking about, or whatever. So what I want to do is show you how to do this for yourself if you needed to. So cash from operations on Seeking Alpha, it's this line right here. So we'll plug that in our calculator, 5943, and then capital expenditures. And depending on what you are using, that may, if you're on Seeking Alpha, it's on this top row here. Some websites will say change in plant, property, and equipment, I believe is what it's listed as. So what I'm taking is cash from operations, and I'm subtracting the capital expenditures. I don't want to penalize them necessarily for the money they spent to reinvest in the company. So I'm going to take this minus this. And we've got 2,711 left over. Now, what you would care about is that increasing year to year? So you could go through each year, or even actually I would just suggest, since we're doing this, just take this year, figure it out, and then this year, figure it out. And did it increase? Did it improve? Free cash flow is the number one thing that I look at on a company. So free cash flow, and then I would say total revenue, and then net profit margin. Those would be my three things. If you guys are like, I'm too lazy to do this, Hunter, I am not going to go through and do this even for my quick valuation. I'm not going to do all 6 of these. At least do those 3. Let's redo the free cash flow real quick. It has gone up for Tesla to $2,000. So revenue was up a lot for Tesla, which makes sense. They're a very fast growing company. Net income has gone up a lot, which makes sense. They're a fast-growing company. And so has free cash flow. So those are things we look at. Has it gone up? Our net profit margin was 2.19%. That's not great. But when we looked at the competitors, it was slightly lower than them, but not abysmal or anything. If GM and Ford were both at a 12, we'd be very worried, right? Number of shares outstanding has gone up significantly. So each of your shares are worth quite a bit less than they were 5 years ago. And then their TCA over TCL, which is kind of like the health of the debt of their company, is very good. So overall, with 4 out of 6 checks, personally, if it's me, I'm saying, okay, I got a couple questions to ask. I would say, okay, let's go through Ford and GM and some other companies and see what their net profit margin is. The shares outstanding, again, I'll cover in another video, but it's common for growing new companies to sell shares as they go. You actually even kind of want it. This is very nuanced. It needs its own video, but you wouldn't really want it growing this fast. I'll say that. But anyways, we got enough checks to continue. If you're going through here and only one of these is a yes, I personally don't waste my time. I'm done with this. And I also want to preface this. I meant to start the video with this. Everything we're looking at here today is from the perspective of, I don't want to say a value investor per se, because I don't like to put titles on that. You know, investing is its own thing, and there's value aspects, there's growth, and I want to teach you how to do all of that and what it all means. And as you get more experience, it'll click in your mind how what I mean by that. But I also don't want you to invest in dangerous companies, right? But what we're looking at today is just showing you the health of the company. We're not talking about swing trading or momentum trading. When you're doing those things, you don't give a rat's but what any of this says. Okay, you don't care what the stock is. You're just riding momentum of the market and what is happening with that stock at that very moment. This is from a longer term perspective. You're actually wanting to invest in the company, right? You want to put your emotion and your money into the company and care about how it's doing, and every year do a little check in on them at least once a year. Watch a conference call every now and then, and just kind of get an update on how things are going for them. This is what the steps you would take. You have any questions so far?
No, this is great. It's really interesting to see the ins and outs and how a company really is something that you're vested into, and that you need to know how it's performing overall, and you need to do your research to see what the meaning behind the various numbers is, so you can make a good judgment on it. And it's definitely it will save people just going into buying a share in a company just because of the name, and they might have a better insight into it. So yeah, it's very good.
I would say it's more important to do this now, as the market currently is. It's probably never been more important to do this kind of stuff now, because when the market is very overpriced, the companies that have a very rich valuation, like Tesla would be one of the poster children of that, when a correction happens eventually, and I'm not going to try to guess when it could happen, but it will happen at some point if the last 130 years have shown any indication. The companies that have way outgrown their valuations are the ones that fall the hardest. That doesn't mean you have to be super safe and only invest in Coke, Pepsi, and Kraft Heinz, but you want to keep that in mind and go through for each company and see what does it actually make sense for this company to be priced at. So this is a little more in depth than we'll get today, but let's say I even wanted to, this number is growing very quick, right? Their revenues are flying. Year over year, their average over the last 5 years has been a 50% increase. That's extremely impressive. So let's say I even want to give them a 50 multiple, which is the highest I could even fathom in my brain, given a company a 50 multiple. Even then, because they don't make money yet, and this is telling me I shouldn't even buy them, it's giving me a negative number. Now this just goes off of free cash flow, so let's give them credit. Let's change my thing here. Let's give them credit. Let's say that becomes their average over 5 years, and then we'll give them an actual respectable 20 multiple. So if they kept this up for 5 more years, they'd be worth it, right? That's the question, though. 5 years is a long time. Hopefully they will. But anyway, it's going to help you guess, is this company super overpriced? And again, if you want to trade them short term based on momentum and all that, then that's fine. But what you can't do is justify in your head that they are worth what the numbers are showing you they're worth, right?
Yeah.
For the second company, we're going to be covering Medtronic. They are a medical device company. I just randomly picked them because they are apparently big here in my country and in Nigel's country of Ireland. I work in healthcare on my 9 to 5, so I'm pretty familiar with Medtronic. So I'm going to have Nigel be running this. I'll tell you which metric we're on and ask you the question, and I'll just have you go through the financial statements and you find the answers and report it back to me, and we'll check your work as we go. Does that sound good?
Yeah, perfect.
Okay, cool. So we'll start with revenues. Has it gone up over 5 years?
So yeah, if we look at the revenue, we can see that there was a trend where the revenue was climbing for a good 4 years, and then we have a slight drop off there towards the end. But I suppose if we draw an average, you would probably find that it is up over the last 5 years ever so slightly.
Yep, just barely. 28,
Just barely, yeah.
833, 28, 913. So that's a yes. All right, let's look at net income over the last, we'll say 5 years.
So if we have a look at the net income, we'll see over the last 5 years that it's kind of fluctuating between 3 and 4,000, but over the last 5 years, yeah, we've had an increase.
So let me ask you a critical thinking question here, Nigel.
Sure.
If their revenues have basically been flat, they went from 28.8 to 28.9.
Yeah.
But the net income has gone from 3.5 to 4.9.
Yeah.
Has their net profit margin been getting higher or lower?
So their profit margins are increasing. So they're doing something where their revenue coming in isn't as high, but maybe the operations of the company have become a bit more lean, or they're doing something.
Exactly. They are being much more efficient in spending that money. So their net profit margin, let's just use this to get us I would bet it's almost doubled. Not quite, but it's went from 12% to 16%. That's quite impressive. To be barely bringing in more revenue, but to have a net profit margin that big, that's pretty impressive. Okay, I'm sorry to interrupt you there. So that answers our net profit margin question as well. So it was 13.8%. Let's go down to on the income statement at the bottom.
So we're looking for weighted
basic
shares.
On your guys at home, it may not say weighted. It may just say base. It's probably going to say the word basic though. So shares outstanding.
So here we're looking at the numbers from 5 years ago, and we see that there's a trend there where the shares are decreasing. So the company is buying back shares. So it means if we own a share in this company, that share is getting more value as long as they're buying back shares.
We'll go to balance sheet. Okay, so what about our TCA over TCL?
So we're looking at our total assets, current assets, which is what the companies could sell off easily enough if they had to. And we're seeing that that value is increasing over the last 5 years. And so they have more assets, more disposable assets. And then if we look at their total current liabilities, we can see that their liabilities have increased also. So you'd probably have to do a ratio between one and the other to see
and
whether they can their assets meet their liabilities if it came to it.
And guys, as you get better at this and doing math in your head, you won't even need to bust out the calculator. You can just look and say, actually, especially for this ratio, this equation particularly, it's so easy. It's just, is it higher, right? Is TCA higher than TCL? But also in your head, you can be like 8.25. 8 times 3 is 24. So our ratio is going to be 3 point something. Right. And then lastly, we're going to go to our cash flow. Now for this, we will have to do a little math. But for this stock, I'll tell you how to do it. And for the third stock, you're going to do it without any instruction from me. So what we're going to do is go to 2016 of April. We're going to take cash from operations. So 5,218. And we're going to subtract capital expenditures. 1,046. What's that give us? So 4,100. All right. And then the most recent year, or we'll just go most recent full year here. $6,000. So it's gone up quite a bit. 4,000, a little over 4,000 to 6,000. So that's a yes as well. So we'd definitely be interested in this company. How many checks do we have overall? They're a yes on everything. Damn. So now at this point, just a quick digression, but if we saw yeses on everything, we would then try to figure out, well, for one, we'd move to the next step. So I'll be doing more classes and more videos like this. We'll do a 200 series where we'll kind of get into how to assess how fast the company is growing, what things to look at, and the math to do to figure that out. And then in the last class, we're going to cover some other ratios you can look at, like ROA and ROI and all that jazz. But how to put all this together to come up with a price range target that you want to look for, if you want to invest in them strictly from a value perspective, or if you can decide that you don't care about min-maxing your returns. You just say, I figured out this is a good company. I want to buy it. I want to hold it long term, and that's the end of it. And that's totally okay.
Sure.
So in future classes, I'll teach you ways you can develop your own, like how to mentally assess all that and decide that for yourself. But this would be a definite, let's keep looking further into this company. Let's figure out if I want to invest in them long term, or if I just want to trade them from a value perspective. Now, what price do I want them at? This is where we would go after that. So the last one, we're doing CRH. Now, if you're following along at home and you're watching this on regular video, and you want to take Nigel's position, then just pause this video right now, go through the 6 things that we're looking at, and come up with the answers ahead of time to kind of check your work and see if you're learning. And I'm also going to do a quiz at the end for everybody as well. But I'll have Nigel, I'll have you walk me through each one step by step and tell me. You don't have to tell me the exact numbers, just tell me revenues. Are they, yes,
so
no?
The first thing we're going to look at is, has the revenue been going up over the last 5 years? So if we look here, we can see that there's been a nice steady increase in revenue. So they're bringing more money in, and then that kind of leads us to ask the next question, which is, how much money are they actually getting from all that revenue? So after their expenses and stuff. So we're going to then look at, so the first thing is a check mark from revenue. And then we're going to have a look at operations, or income, net income. And we'll see here that also over the last number of years that their net income has also increased. So that's a positive. So as you pointed out, we can divide our net income by our revenue, and that will give us a percentage as to what the ratio is between the two.
What would that be for 2020 or 2019? Sorry. What would you look at?
So I would look at the last year, so the most recent year of net income, and divided by the most recent year in revenue.
Exactly. So I'll do that for us real quick on the calculator. So 23.3%.
23. So that's a check mark there. So then that brings us to the next, which is the shares outstanding. The share to check whether as a shareholder, are they removing shares or adding shares? So in this website, it's called basic weight average outstanding. And here, if we have a look at these numbers here, we can see that the numbers are decreasing over the last 5 years. So that's another positive check mark. So now moving on to our balance sheet, we are now looking at our total current assets. So our total current assets here, we can see are increasing. So which means as a company, they have things of value that they could dispose of. And if we compare it to their total current liabilities, which is the costs they have, we can see our assets are greater than our liabilities, which is also a positive thing. So finally is the cash flow. And here we want to find our free cash flow. And the way we're going to do that is we're going to compare our cash from operations with our capital expenditures. We can see our cash from operations is increasing there over the last 5 years, which is a nice thing. And if we divide or subtract cash from operations by capital expenditure, we will see what they are left with as free cash flow.
And we can tell just from by glancing that it would be going up. Obviously, if 94 minus 9 is 15, 38 minus 13 is 25, right? So
yeah.
All right. So how many yeses and nos do we have here?
So from we've had all yeses in this case. So this kind of leads us to then go and have a deeper dive.
All right. Let's check Nigel's work here. I'm okay. It did populate. I was going to
Oh,
say, with it being an Irish company, I wasn't 100% sure if it would, but it looks like it did. So
so there was one no.
their net profit margin.
Okay, we didn't
It's
calculate that.
getting. Oh, yeah. We never did the math for that, did we? No, we did do the math. It was less than 10.
Was it 7.6?
Yeah. It was almost a 10 last year. So what we would do is we would go through and find out who maybe 3 of their biggest competitors were, and we'd run them their net profit margin last year and see if it's comparable. Okay, so
Yeah.
what that tells me, they got a, let's say last year they had a 7.7. If I do the other 3 companies and they're all within a couple percentage points, maybe some of them are 5, a couple of them are like 9, I would
Yeah.
probably consider this a yes, or at least just kind of an even, like I'm not going to penalize them for it when I
Mm-hmm.
later decide if I want to invest in them or not.
So yeah, one no doesn't mean it's a deal breaker, but it does mean you need to look a little deeper.
Yeah,
And as you said, it could be industry, a characteristic of that industry.
fantastic job. He's a
That's
pro already.
great.
So, guys, again, this is, if you're brand new to stocks, this is a little intimidating, but I promise you that it actually only gets easier from here and
Mm-hmm.
more interesting from here. Diving into the details of the company, if it's a company that you actually are interested in the first place, is actually kind of fun, in my opinion. This kind of gets you started, gets your mind wrapping around what does total revenue mean? What does net income mean? And we saw Nigel was able, when I asked him if they're making about the same revenue, but their net incomes are increasing, now that he knows what those each mean, he was able to tell me that the net profit margin is higher, and how it got higher. They are being more
Mm-hmm.
efficient in how they're spending money, right? There probably is like efficiencies within the inner workings of the day-to-day business, or some suppliers, maybe they got some discounts with some suppliers they've been with long enough. The more you do this and the more you learn, you'll be able to kind of guess and understand why things can happen like that. All right, let's do a quick quiz for everybody watching at home. Guys, if you're watching and you feel like you've learned anything today, then do the usual like and subscribe and all that. If you want to join the Discord, I have a free option and it's in the description below. But let's do a quick quiz here. Now, if you're watching at home and you want to join with us, I encourage you to do so. If you need more time, just pause after you see each question and then hit play whenever you think you have the answer. So, Nigel, which stock would likely have a higher net profit margin, Facebook or Walmart?
So the net profit, who would have? So Facebook would have a higher net profit because Walmart is one of these companies that have a slow or a small amount of margins on their products.
Right.
Facebook is a company where the cost of them selling their products, they get more profits for each.
Exactly. And I picked these 2 companies because they're in industries that are kind of on opposite scales on net profit margin. Software and internet companies tend to be high profit margin,
Mm-hmm.
and there's multiple reasons for that. They don't have a lot of physical locations that they have to be leasing or buying the land for and all that. They software, once you get it developed and pay your developers to make it, you then don't have to
Mm-hmm.
really pay as many, and so your product keeps running itself. Whereas Walmart, they have to run a lot of physical locations, a lot of salespeople, and so on and so forth. So retailers are always the worst. So yes, Facebook would be the answer here. Number 2, what is the equation for calculating net profit margin? What would be on top here? What would be on bottom?
So yeah, that was the mistake I made earlier on. So we'd have to divide our net income by our revenue, and that would give us our net profit margin. Is that right?
Yep, 2 for 2. If a company sells more shares, is my share worth more or less?
So if they're selling more shares, it means whatever shares I have is decreasing in value because there's more shares available. So
Bingo. What ratio do we want to see for TCA over TCL?
So you're looking for a ratio that's greater than 1. So at the very minimum, we want them to be able to, that their assets can pay for their liabilities, but it would be best if they had more assets than liabilities. So a ratio of more than 1. Great.
All right. Which of the following is not an example of a total current asset? Cash, income taxes due this year, accounts owed to the company by the customers, or stocks.
Number.
This is the hardest one on here.
Was an example of a
Which one is not a total current asset, you think?
income? I don't really know. Cash is an asset,
Yep.
is it? Their stocks are assets because even if they drop, they can be sold.
Exactly.
Accounts owned by customers
Owed.
owed.
Meaning,
So that's money coming into them that has to come in at some stage. So that's an asset. So income tax due to them is an expense.
right. So this is what B, income taxes due this year, would be.
Due this year.
It would be a TCL, I believe.
A liability.
At the very least, it's definitely not an asset. It's money that they
For
owe.
sure.
That's a hard one, but that's the hardest one on here.
Yeah.
But yeah, good job. See, critical thinking. You understand the concepts, and
Work your
so
way through.
you were able to figure it out. And then out of these, which trend do we want to see decreasing with time? Free cash flow, revenues, shares, or net income?
So it's our shares outstanding that we'd like to see decreasing, because if you're a shareholder, it means your share is then increasing in value.
Exactly. 6 for 6. If you want to be in Nigel's position at some point, so what I would like to do with the channel, just to briefly do a quick summarize of kind of what I'm hoping to accomplish here, is I ideally wanted to teach high school students in like after school classes. It's proven a little harder with scheduling, and especially now with COVID, to do that. So I wanted to do this online through YouTube and through Discord. Discord is better because you can ask me questions as you go, and I can also get information into text form quicker than I can make videos. So if you want to join Discord, you can do that. But my goal is not to have you rely on me. I want to teach you how to do everything yourself and let you start taking control of your own life. Too many of us live paycheck to paycheck, and we don't have any kind of savings for an emergency. I don't just cover stocks, guys. Actually, stocks is, I enjoy stocks and I know quite a bit about them, but stocks is only one part of what I want to cover and eventually get into the Discord and the YouTube. I want to talk about primarily how you can start building your wealth. This is a slow process, guys. There's no get rich. There's no a million contracts of call options on Tesla and then you're set for life. That may work for 1 out of a million people, but it's not going to work for you. You need to learn how to balance your household budget, how to invest, which stock. I'll help you learn which stocks to invest in, or at least grasp the concept so you can make your own decisions. And I'll teach you what are your retirement options, how to avoid taxes, how to kind of minimize, maximize, and any questions you can have, even if it's like, what kind of life insurance should I have? Like, I am more than happy to help you out and explain and help you learn how these work so you can take control of your own. I'm not trying to get you to pay me to run your portfolio for you. I will if you want me to, but that's not what I want to accomplish here. I want you to learn the basics so that you can do it yourself. And if you just want to learn enough to get things set up and then never touch them again, you can do that. And if you want to learn enough to really go in depth on stocks and you find out you like this stuff and you really want to be an active investor, then I can definitely help you do that as well. So that's the whole goal here. But if you want to take Nigel's part here and you want to be the student one day, that's kind of my goal, is we build a community. You guys can join and you guys can take turns doing live lessons. And again, if you're in the Discord, you can be messaging me questions day to day. It's basically like texting. If you come up with questions, you can always ask on there and I'll eventually get to you. So thanks again, Nigel, for being with me today, being part of the
Thanks for your
first,
help.
being the first student here.
This is really great. It's really benefited me, and it's a real challenge. And as you mentioned, Hunter, the more you get into it, the more you kind of want to know more and dig a little deeper. But definitely getting started is the most difficult, and it does take a few times of just kind of sitting down and going through the spreadsheets and just trying it and trying it. But once you find a small technique, it's kind of a snowballing effect, and will kind of build, I hope. Anyway, that's my experience.
Yep, you're exactly right. And that's what I was trying to preface it with, is saying that this is the hardest part when it comes to stocks. Learning the foundation is the hardest part. And like you said, exactly, a snowball is a perfect analogy, because once you understand some things, when you go to understand the next concepts, when I try to teach you what a revenue year-to-year growth is, it makes sense. If I try to teach you what return on capital is, it's going to make more sense now that you know certain things. And if you get through my 100 classes and you get through the 200s and the 300 classes, and you're still like, you know what, I don't like this crap, I'm not going to be able to do this, then that is totally fine. And in fact, it can even be a good thing, because I want to teach ETFs. I want to do a lot of teaching on ETFs and the difference between them and mutual funds and index funds, how to pick ETFs, what to look for on there. There are metrics, just like with stocks, where you would look at certain things to make decisions on your ETFs as well. And you can let them run things for you at a very low fee. Totally up to personal preference. So I want, again, with this channel, I want to go over everything and let you guys learn and then make your own decisions. So thanks again for joining me. I think that'll be good for our first lesson. And then I hope to be able to do this once a week, as far as any video at all. And I hope to do it at least for now, one teaching lesson a month, probably more once I get the ball rolling on things here.
For everything.
Thanks, Nigel.